Friday, December 27th, 2019, Maneco 64, home of alternative economics and contrarian views. I'm later today. I decided to play some golf as things are fairly quiet. The course is dried up. It had been raining a lot the last couple of weeks. So I'm doing an early afternoon update or pre-open New York update. We've only got about 25 minutes to the open. Before that though, I'd like to say Billy's got his silver bar and he's also got a Krugerrand paperweight. It's not a real Krugerrand. It's quite heavy. If you want one of those, you can go to the goldinvestments.co.uk website. You can contact them and say that you'd like to buy one. I think they cost about £20. It's a Krugerrand paperweight. Not real gold. It's not gold plated. It's just a bit of fun. Today, I want to talk about 2019, what I think was the most important development in the financial markets, in the monetary system, in central banking. And for me, that was the year the Federal Reserve realized that normalizing monetary policy to pre-2008 crisis mode was impossible. To put it more succinctly, it was the year that Jay Powell realized that it wouldn't be as easy as watching paint dry. Like Janet Yellen said when she pre-announced quantitative tightening, she said it would be as easy as watching paint dry. So here we are about 13 months later, because I remember in February of 2018, a lot of analysts, economists for Wall Street, City of London, they were forecasting for rate hikes by the Fed for 2019. They're forecasting a continuation of the balance sheet unwind of the Federal Reserve. They thought it was going to keep being very easy. But as we saw late last year, the stock markets were imploding. So basically, normalizing policy will lead to a demolition of the system. That's what we realized in 2019. So what are the consequences of that? Well, I think we're starting to see it already. The consequences of that are that the central banks, the Fed especially, also the ECB, the Bank of Japan, the Bank of England, they will never be able to normalize policy again unless they want to bring everything down, a deflationary collapse, an implosion. But the flip side of that is that investors and the general public are starting to realize that this game of funny money creation, of inflation, will never be able to turn off. That's going to lead to a loss of confidence in the monetary system, a loss of confidence in the fiat currencies, especially the US dollar, as the US dollar is the reserve currency. And why is the US dollar so important? Well, because the whole system, the whole fiat currency system all around the world is based on the fiat dollar. It's a derivative of the dollar going back to 1944. So they've all been built up on through dollar reserves. And that's what you need to understand. This is not just going to be the dollar that's going to collapse in terms of relative value against anything that's not fiat currency. That could be stocks, that could be tangible assets. It will definitely be precious metals. It could be cryptocurrencies. It could be agricultural staples, anything that you can't create so easily that takes a little bit of effort. They're all going to implode. And I think 2019 is the year where this process started. Of course, it's still in its early stages. And I think hyperinflation or loss of confidence as I've studied and read through many books, going back a few hundred years, looking back at the assignats in post-revolutionary France in the 1790s, looking back at Central and Eastern Europe after World War One, with the Weimar Republic, of course, with Austria and other countries, confidence is lost like all of a sudden. It's like Jim Rickards talks about the snowflake that eventually, the little snowflake that eventually starts the avalanche. So if you're if you think you can protect yourself in a smooth, if you think this hyperinflation is going to happen in a straight line and that it's not going to accelerate, you're going to be wrong, in my opinion. And that's why you need protection outside fiat currencies. And that's why we're seeing, in my opinion, the melt up in the stock market. We're seeing the melt up not only in the US, but other world stock markets, even though they're still undervalued against the US stock markets. We're continuing to see commodities starting to move up, like crude oil. We're starting to see also copper starting to move up. Granted, the CRB index still has a lot of room to go. We're starting to see gold also starting to break out again after the consolidation we've had in the last few months. Silver is still, of course, very undervalued. I think there's a lot of potential for silver. So that's what 2019 was for me. So have I got any forecasts or any bigger picture view of 2020? One thing I would say is that 2019 was unexpected. If you look back at 2018, towards the end of 2018, who would have expected the Federal Reserve to cut rates 3 times and actually stop the QT and actually increase their balance sheet by about 400 billion? Who would have expected that? I think very few people expected that. So I will make a speculative, how can I say, forecast here that we're actually going to see the Federal Reserve and other central banks have to raise interest rates next year. And why do I say that? Well, I think it's because if people start losing faith and confidence in the paper currencies, and you see a complete melt up in all assets, the only way to stop that will be to raise rates. And I think that's one of the possibilities that people are not looking at. How much do I give that? What are the odds, in my opinion? Well, I would say like 33%, a third chance. Apart from that, I think we're going to continue to see things melting up. That's the biggest probability. I think a controlled melt up and rates remaining low and more QE. But I think if faith and confidence is completely lost, then there's no other option for the central bankers. If they want to keep their job, if they want to keep the fiat currency system going, they're going to have to attract people back to those fiat currencies. And the only way you can do that is through higher interest rates. Just like Paul Volcker did in the early 80s. He let the market set rates. Rates went up to 20%. The discount rate, the 10-year yield went up to like 16%. So that's my wild speculative forecast for 2020. Of course, am I saying it's going to happen? For definite, no. But I think it's something that one needs to keep in mind. My strategy doesn't change for 2020. I'll try to stay outside of the fiat currency financial system as much as possible. I'll stick to my precious metals, some cryptocurrency. It's a small part of what I hold, but I think a little cryptocurrency could go a long way because I think cryptocurrencies have a lot of upside. It doesn't mean to say I don't think precious metals don't have a lot of upside. Now let's look at where the markets are. It's 2 p.m. London. We got 15 minutes till the open in New York. Not surprisingly, the stock market continues to go up. Right now, the Dow future is up 71 points, 28,691. It's down about 40 points from the highs, so it was up over 100 points earlier. S&P is up 7, 32.47. The NASDAQ 100 future is up 30 or 1/3% at 88.06. Precious metals did very well yesterday. Gold got up overnight up to 15.14. We're off those highs. Gold is virtually unchanged from overnight. It's at 15.11. Technically, it looks very good. We've broken out of the trend line in the upper trend line in the falling wedge, and we've also gone back above a level that I've looked at many times in the past, and that's 1483. Why is 1483 important? Well, because it's the 50% retracement of the move from the high in 2011 at 1921 and the low in December of 2015 at 1046. And during the consolidation we've had in the last few months, in the beginning of the consolidation, gold was holding above that level, and then it broke below that level. But the fact that we're comfortably above that level is quite important, in my opinion. Silver yesterday was doing quite well, was above 18, and it looks like there was kind of a concerted move against silver in order to try to keep gold down, because they couldn't keep gold down, so they went after silver. So silver has been struggling to get back above 18, but I'm not concerned. I think silver is going to continue to do well as well. Right now we are unchanged at around 1790. The range has been 1775 to 1795. Currencies are quite interesting today. We're seeing the dollar get hit hard today. The dollar index is down about 0.5%. We've got sterling up 0.75% at 130.95. We've got the euro up over 0.5% at 111.56. Dollars down 0.1 versus the yen at 109.51. Virtually unchanged against the yuan at 699.24. Just want to show you a couple of charts of the dollar index. One is a 2-year chart, almost here, January 2018 till now. And you can see that it looks like we're forming a top, head and shoulder top here in the dollar index. You can see it's down about almost 0.5% today. And yeah, I think the dollar index topped in 2017. And I think we're going to go lower in the next few years. I've made videos in the past. If you go into my channel, or I'll put it up in the cards, about the cycles in the dollar index. And here you go. Here's the long-term chart of the dollar index. It's a monthly chart going back all the way to the early 70s. And looking at the cycles, the dollar index makes cycles, tops and lows every 7 to 9 years. And I think we made a top in January 2017 at 103.82. Yes, it has rebounded since the beginning of last year, but I think it's losing momentum now, as you saw in the shorter term chart, and we're going to continue to go lower. I think we could continue to see the dollar index go lower up until 2023, 2024. Just because the dollar index is going down doesn't mean to say that the best way to hedge having dollars is to go short the dollar index. I think you need to be holding precious metals. And even for people in Europe, they need to be holding precious metals as well, because gold is going to go up quicker than their currencies might go up against the dollar. So to sum up, I think 2020 will be a very interesting year. Outside chance of rate hikes. And also 2019 was a pivotal year. It was the year people realized, central bankers, investors, even some of the general public, they've realized that the central banks will never be able to go back to how things were before 08. And if they do go back to that kind of monetary policy, normal rates like at 5, 6, 7%, the whole system will implode. It will be a demolition. But the flip side, of course, is the way we're going is also going to end in tears. It's going to destroy the currencies, and that's what I'm seeing. Is it going to happen in 2020? It's going to accelerate in 2020. It could happen in 2020, but who knows? If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. Make sure you share this video far and wide as it helps. And you can also follow me on Twitter, BitChute, Steemit, and on DTube. I wish you all a great weekend. Take care. Bye.